All right, welcome to the Legal Hour with Marty Tate. I'm your host, Greg. We're joined by one of the leading security lawyers in the space, Mr. Marty Tate from Carmen, Linoff, and Israelson. Marty, how's this past month treating you?
It's good. It's been really good. How are you doing, Brent?
Good. You have a good religious observation holiday.
Nice.
Depending on your religious persuasion.
Yes. Yeah. It was good. Yeah, I actually spent some time back in DC, so that was good.
Nice. To start off this month, I thought we'd kind of review and take some of the mystery out of regulation, CF, and regulate groups that are looking to do both those offering types. What are the top three things you would recommend someone looking to get it approved by FINRA for a Reg CF portal? What are the top three things they have to do to be prepared for the review process? So before they sign up with CrowdEngine, before they go, there's always that panic or concern of what do I have to do to be ready? What advice can you give them as far as what could they do to be preparing for the overall process?
Well, shameless plug. Well, they can call me, and I can do a checklist and a due diligence checklist and give them all the items they need to prepare for that. But the biggest things that we see is even once the application is filed, we're noticing that there's no real rhyme or reason to why FINRA does what it does or how it acts. I think that the three fronts that they would miss that they need to be prepared on where we get pushback is one, they have to have, to make sure that the platform itself is, I would say, 90-95% of the way there.
Done.
Yeah. Configured, content, everything, because what you don't want is just a whole bunch of placeholders that you come back and say, hey, we'll figure that out. FINRA wants to be able to go in, cruise through your platform, and check everything out. And if there are things that are there, that's just going to be what they'll do is they'll give you basically the equivalent of an SEC comment letter that you've got to respond to. So if you want to minimize the number of comments you're going to get back, you want to have things done. You want to have it functional and work in a way that is compliant with the rules. If there's something that doesn't work, or if there's something, for example, you don't have the technology built out that provides a way to screen out or identify insiders, you want to make sure all of that's done. Same with the language on it. You want to have your language prepared so that they can go through it. And you want to have it with you where I'm seeing pushback is, ABRAG, Department of FINRA, is picky, and they're going through word by word, and if there's a word in there they don't like, they'll let you know, and that might be a week.
Yeah, they let you know with the delay in the process because of it.
Yeah.
So now what would have been potentially approved, you now have 2 weeks, 3 weeks, a month delay.
Yeah, and what's been frustrating for one of my clients in particular, but some of my clients, is that process isn't just here's everything, fix it, good, you're done. It's they'll come through and they'll say, okay, here, fix all these things, and then you'll fix it, and then they'll go back and say, well, now we just don't like this. And we want you to change this title in this section. I mean, just little things like, something that looks promissory, or, I have a client that's doing a site, and they were talking about, they had a section on how basically their model stacks up to, they had a sort of an alternative investment model, how it stacks up to traditional debt equity. And I thought that was, I looked at it, I thought it looked fine. This is, how debt typically looks, this is how equity typically looks, and this is how their model looks, and I thought it was fine, but FINRA tore it apart. They had kind of a graphic there, and they didn't like anything because it looked promissory. It looked like you were saying, well, based upon this, it looks like you can guarantee these returns. So that's probably the second thing. And then the third thing is just making sure you have all of your sort of housekeeping items in order. You're required to file not only your cap table, but you're required to provide information on everybody that's funded the platform, so all of the principals. And you need to make sure that you have all of the documentation in place. And sometimes that documentation doesn't even exist. You come in and say, well, these are the founders, and this is how they came on board. They don't want to understand what money they put in. You need bank statements. You need every single piece of, and bank statements from both the transferring bank and the receiving bank. It can't just be one. They want proof of every single thing. They want documentation to back it up. If there was a loan, if there was a convertible debt, they want to understand all of that. If people receive, this is something that I recently learned. We had where employees received equity compensation by virtue of them being employees. They didn't put money into the fund, into the entity, but they did provide services, and we had to provide employment agreements. That's something that I was new that in previous branches. I hadn't seen that. So it seems to me that they want a very thorough.
It sounds like less is more. Is it appropriate to say that if you provide all the content, that you keep it more minimalist, that you're more likely to go through with less? You give them a lot more material to review. There's a lot more material they can find exception with. And not that you're misleading anybody, nor would I want to condone that, but as far as to get to the review process, have a more minimalistic approach. And then upon approval, if you need to refine something, because how do you manage it once you're approved on managing the content you post?
They'll still go through. I have a client right now that was approved early on, and they're going through a FINRA review right now. So they're not.
You're not free and clear. Big Brother's always there.
They're always there, and they're going to be looking at things and making sure they're compliant. We had a client that was approved and then started doing some promotional activities to try to promote their site and kind of, I don't want to say trouble, but caught the attention of FINRA. So yeah, you're never rather look. But I think the less is more is good, but that's a catch-22 because you don't want to be deceptive. You want to say, okay, we're going to just basically say we are a crowdfunding portal and period.
No.
You want to be able to. You want it to look like it's going to look when you are approved. You want it to say what it means to, and have you, in order to differentiate yourself from the other platforms, there's got to be, you've got to tell your story. You got to say why you're better, or why you think that you stand out. So that's the thin line you have to walk and say, we need to tell our story, but while telling our story, we need to make sure that we're not crossing any lines that are going to just raise our proposition.
Perfect. So what are the top 3 things Reg A Plus applicants need to be prepared for their FINRA review? So
their FINRA review really, it's an SEC and a FINRA review. So the SEC, and they're 2 different animals entirely. I'll talk about FINRA first, and then we'll talk about the SEC. FINRA, it's the 5110, and that really has to do with any broker-dealers, or it has to be filed regardless of whether you have a broker-dealer or not. But it really just discloses anybody you're paying to, paying to help you with that raise. So it's just not using a broker-dealer, pretty simple process.
Are marketing agencies like a CrowdFundX or a crowd, would those be on that list if they're helping you raise that capital?
No, because they're not being paid. They're not really being paid as promoters. Okay. They're just being paid to provide
marketing services.
Again,
there's some gray area there.
To the extent you are doing Reg A offering, Reg A Plus offering, and you have a broker dealer multiple broker-dealers, they're going to be familiar with that Form 5110, and that just needs to be completed. The FINRA is going to look for just consistencies throughout your agreements that you're offering circular. So that's the FINRA side. The SEC side is a whole, it really just depends on the structure. I mean, if it's a REIT, you're going to go through a whole different set of, you're going to get in front of a whole different set of eyeballs than if you're just an operating company who's going out trying to raise money for their working capital.
So funds and REITs get a different review process than a kind of a public round for an existing business.
Yeah, they're going to get, they're going to get exactly put in front of different departments because they're just different.
The nature of the raise is different.
Yeah, and so being ready there, I don't know if there is a top 3 things. You've got to make sure you've got your financials. Your financials are in order. You want to have all of your material agreements because you've got to file those. If you just need to make sure, I've got a checklist. I send it to clients. I say, fill out all this information, provide me a lot of these documents, and that's designed to have everybody think through the entire process and get everything in the front so that when we file, we're going to minimize the number of comments we get. That being said, you never know.
Yeah.
I mean, it's a process, and it takes, some people get through with 1 or 2 rounds of comments. Sometimes it takes more.
What's your current timeline you're seeing for FINRA and Reg CF reviews? A few months ago, or 6, 8, 9 months ago, kind of 3 months was the norm or expected. What are you actually seeing now? Now that we're out a year or so, what's the expectation people should have to go through the FINRA review for Reg CF portal and the SEC FINRA review for Reg A Plus rates?
So Reg A Plus, there's so many moving targets. It's hard to say. I mean, like I said, it's a simple operating company. We'll work down one out. The number of comments we got back were pretty minimal, and the review process was pretty short. I mean, I think it was still, it was probably 60, 75 days.
Nice.
Which I thought was short. If you've got a complex REIT-type structure where you've got multiple broker-dealers and placement agents and prior performance tables that you're having to complete, it raises a lot more questions, and it's a lot more difficult to get it right the first time. So there tends to be back and forth. But I think I just don't know if there is a normal. This is how long it takes because everything's different.
Perfect. So what's the most common mistake you see come across the industry? Not necessarily industry, but of these people, of the work you see and or do, the conferences you attend, where do you see the most common mistakes or mistake being made?
I think this is an evolving issue. Early on, I think the most common mistake was just people not even understanding what they were getting into or what it meant. I think we talked about this in our last chat, that we're seeing more sophisticated groups entering the space, people that have actual operating companies that are, looking at raising capital online and are looking, towards the current regulations as a way to bolster what they already do. So I think that, early mistakes were just, again, anybody thinking, hey, I can go in and do crowdfunding because just not even understanding what it was. Now the mistakes you see are less that and more. I think it still comes down to the ability of, we've talked about this I think multiple times, the ability to market the deal. I think that I've hit this over the head at conferences I spoke at, we talked about it. At the end of the day, it's a marketing play. It's legal. The legal side, I think, is pretty straightforward. People get caught up on that because it's
It's the unknown.
Those legal changes that make this possible. At the end of the day, it's a marketing play. How do you intend to drive investors to your site? And that's to me is like the ultimate holy grail there. And if you can figure that out, if you have that ability to do that, you're going to be successful.
And marketing by nature is right. Right. But wherever they draw the line, you're going to have someone interpret the line slightly more to the left or slightly more to the right. Some people are very conservative, never come close to the line, and someone, no matter what the line is, they're always going to put a foot over it just to see if they're going to get it, caught. So let's talk about the Financial Choice Act for a minute. Obviously, there's a lot of buzz around the industry about the Financial Choice Act. What have you been hearing? What for the people that aren't aware of that, maybe explain what the Financial Choice Act is.
Well, right now it's nothing. It's just a proposal, and it's something that I honestly didn't know a lot about. Just have really read about it for the first time, but it's kind of I saw one article that called it the GOP's shot at rewriting Dodd-Frank. So there's a lot in the financial regulation space, but how it affects Jobs Act, I think that there's a major rewrite of Title III, Reg CF in the Jobs Act, which would address a lot of the, there's also this Fixed Crowdfunding Act that the representative is trying to get through. But a lot of those issues are addressed there, increasing minimums, increasing the amount you can raise, allowing test the waters, allowing SPVs. Those are things that I think are going to be proposed. This Financial Choice Act also proposes increasing the threshold for rating plus offerings from 50 million to 75 million. Inflation adjustments allows to all issuers under the Jobs Act to test the waters, which I think would be a benefit for in Reg CF. I think for a 506C offering, you kind of can do that anyway, unofficially. And there's a number of other changes. So it's something I haven't read the whole proposed act yet.
Yeah, so I think for all of our listeners out there, definitely take Google Financial Choice Act. I advise you to be kind of familiar with it. And if you feel so inspired to involve your local or national congressional leaders and politicians, it's probably, for those of us who have a healthy stake in the game, it might be advantageous for some momentum.
One industry professional yesterday kind of joked and said it should be called the destroying the 33 and most of the 34 Act. I don't know. It'll be interesting to see. Or death to most of the 33 Act and big chunks of the 34 Act.
So now's the time for everyone to continue to ask their questions. Let's talk about clarity on how an initial crowdfunding round affects the restrictions on stock that the company has previously issued. Is there a connection or correlation there? Does it change anything? Let's maybe talk about what happens when someone chooses to raise capital when they've already had previous rounds, and how does that matter or doesn't?
So the way it's going to affect, it won't release any restrictions. I mean, if you say, for example, you did a friends and family round and did that pursuant to 4.2 or another exemption, that stock's still restricted. And if you follow it up with a crowdfunding round, it's going to remain restricted and can only be sold, basically under Rule 144. By having a crowdfunding round after that, one thing that's interesting about the Reg CF round is that stock that's issued in that round will actually, by virtue of the statute, becomes unrestricted after a year. So it's actually a better type of it's akin to, I guess, private placement stock, and there's restrictions and there's timetables and so forth on it. And I wouldn't say necessarily better. But previous rounds, the biggest effect it's going to have is just going to have a dilutive effect. And that's just what happens with follow-on rounds. They have dilutive effects. They're going to dilute earlier and faster. Now, people get caught up on dilution, and one of my sort of pet peeves in financing and putting together companies is people get stuck on percentages. You have, founders that come together and the guy gets 20% of the company for his contribution, quote unquote, and they get stuck on that 20%. And they're like, well, so you bring that another round, that's going to obviously dilute that person and bring them below his 20%. And I can't tell you how many people get upset about that. Like, no, I want to maintain my 20%. And they don't fully think it through and say, okay, yeah, my amount went down, but it's a bigger pie now. So I have a smaller piece of a bigger pie, which ultimately might still be, equal a bigger piece. If people get so stuck on percentages, and another one of my, this is non-crowdfunding related, but hey, this is just that, where people come and say, hey, I've got 50%, this guy's got 25, and this guy's got 25, and then it just gets stuck in these percentages, which makes later rounds difficult, because I'd rather you just deal with, you've got 100 shares, this guy's got 50, this guy's got 50, and then you sell another round, and you sell 50 your next round, everything gets diluted, and you keep that number rather than being stuck on percentages. So later rounds are obviously going to have dilutive effects. And I'll speak to, just while I'm on the roll here, post crowdfunding rounds, that's been the bigger concern. Is you've got all these people that come into a crowdfunding round. How will that affect a follow-on round? Will that hurt? There's a lot of speculation, and there's still been a lot of talk about, does a crowdfunding round hurt your chances for doing a later, VC round, an A round or a B round or something along that lines? And I don't think there's a clear answer. I think it really just depends on the company. If the company is growing and has the momentum of a regular, especially a tech company or a SaaS company or whatever it might be, if you did a crowdfunding round, I don't think it's going to hurt you. It's going to make your cap table ugly, because suddenly now you've got 300 shareholders, and your VC is going to look at that. Man, that's a nightmare. But the VC might also say, okay, well, great, let's figure out how to put them in a box, or let's maybe try to buy them out, or there might be something they can do. I've suggested with a few of my clients that have done like RegCF raises is to create a whole new class of stock that they're selling, so you can sort of sequester that crowdfunding round into one class with limited rights, so that where a VC might have issues if you give it common stock to 400 shareholders or 200 or whatever it might be, and they all have a vote and they've got these minority rights and so forth. If you can basically come in and say, hey, it's non-voting, you don't have information rights, just limit these guys to basically being purely having a financial interest, and that's about it. It makes later rounds easier.
So, what's the guidelines around doing a crowdfunding raise, a RegCF raise, and Reg D? Can you do them simultaneously? Does there have to be a period of time between those two events? What's the law say?
So theoretically, you can do a simultaneous 506C offering and a RegCF offering. 506B offering is going to be more difficult because a 506B offering doesn't allow a general solicitation, and there's no way of really knowing, because the risk is that you sell to somebody an investor in a 506B offering. The risk is that they say, well, hey, you get this general solicitation for your RegCF, that's how they learn about it, and so it really wasn't private placement. But so long as all of your investors in that 506 your Reg D 506C offering or accredited investors, it is possible. Again, but where you get into issues and complications is that you need to make sure all of your marketing material complies, is Reg CF compliant. So because 506C does not have the same restrictions on how you can market the deal and what you can say. So you don't want people that are investing, your advertisement has to sort of go to has to meet the higher standard of Reg CF, and not, you couldn't have sort of two campaigns because theoretically somebody could see, a non-accredited investor could see a advertisement that didn't meet those requirements. Anyway, thank you, Phil. You just have to make sure that your marketing material is all Reg CF compliant, and then your technology has a way to sort of separate the two out so that the Reg CF portion of the, I know there are portals out there that do sort of allow you to have the two different offerings, but your Reg CF offering obviously has to be through a licensed funding portal, whereas your 506C Reg D offering doesn't. So that creates a little bit of a technology Chinese wall issue.
So another attendee is asking, what are the SEC financial requirements for CF classification, crowdfunding classifications for Reg CF? So I believe it's in comparative to Reg D, would be my guess.
What are the requirements?
What are the SEC financial requirements? Is there a financial requirement?
There are. So it really kind of depends on how much you're raising, and if it's your first time for and I'll back into this with Reg D offerings, as long as if I was to see offering your financial requirements, there are no prescribed financial requirements. Typically, people don't include audited financials with those, or they'll include financial information, and whether it's reviewed or not is kind of up to them. 506B, if you have bring in non-accredited investors, has different requirements and would typically require audited financials. For a Reg CF offering, the financial requirements, like I said, it's tiered, and as long as you are, for a first-time offering, the financial statements just need to be reviewed. If it's a second-time offering, they need to be audited.
So if someone's looking to actually become a Reg CF portal, do they themselves as an entity have to have certain financials to show FINRA to be approved?
No, they don't have to have audited financials. What FINRA is going to care about, in fact, they don't look at balance sheets or P&L or anything. But what they do care about is they care about like I said before, how that company was financed. So if you're financed by debt, they're going to want to see their health. If you have multiple shareholders, they're going to want to see how did they become shareholders, what money did they put in. They want to understand the financing of the Reg CF portal. And that becomes important because there's this prohibition on the funding portal or any of its principals or affiliates owning an interest in any of the issuers. So the FINRA is doing a thorough background check on all of those people and wants to understand who they are so they can cross-check that with the companies that are coming on and raising capital.
Perfect. So can an OTC publicly listed company in the U.S. crowdfund in the U.S.? If you're already publicly traded, can you crowdfund?
No, if you're OTC and say you're a reporting company, under the 34 Act, then no.
So if I did a Reg A Plus round this year and it's successful, I raised $20 million, I can no longer crowdfund.
Well, no, so as long as that Reg A Plus, as long as it kind of takes a different track, right? So if you do a Reg A plus, then Regulation A plus has its own reporting requirements, and you have to file reporting requirements that are similar to the 34 Act reporting requirements with your 10Ks and 10Qs and so forth. Reg A has similar reporting requirements, but they're outside of the 34 Act. If you go through the process and you list on the OTC and you go down the road of becoming a 34 Act company, you're no longer eligible to use some of the quote-unquote crowdfunding rules. That being said, 506, if you're doing a private placement, you're doing a 506C, anybody could do that.
Perfect. What about Canadian companies? Could they crowdfund in the U.S.? There's, if a Canadian company is doing business in the U.S., could they raise capital in the U.S.?
Yes.
Yeah, we talked about that all the time. And since our last webinar, there's been a lot of discussion on the 500 investor threshold, where if you more than 500 investors by people become publicly traded. If there's motivation for your company not to become public, can you still raise capital and get more than 500 investors and not be a public company?
So one thing that they did is under Reg CF, that the shareholders that come in under Reg CF don't count towards that.
The Reg A plus they do.
I can't remember if Reg A plus they do or not. Yeah, I can't remember how that works.
No worries. Let's talk about what outside of real estate, which verticals are you seeing use the crowdfunding laws most aggressively?
So I think you're seeing, what are working. You're seeing it done in the tech industry. You're seeing a lot like on the 506C offerings. People are raising capital and anything from tech and biotech. On the Reg CF, it seems to me that it's consumer products, a lot of breweries and microbrews. I know those were early on; those were popular, as well as in sort of the local businesses, which we kind of predicted. Those are, again, there's not really a rhyme or reason to that. Obviously, in the 506, the accredited investor side, real estate's been the main.
I see oil and gas, and then I also see green energy as a lot of activity around in those sectors as well. So if a crowdfunding client is raising capital for the CF portal, if a company is doing a crowdfunding raise and they're using the crowdfunding portal, what are the market laws around the company directly soliciting investors?
On a Reg CF?
On a Reg CF, they're using a Reg CF portal. What can or cannot they do in soliciting investments to promote their own offering?
It's the same. So that's the stricter, sort of the higher law with respect to marketing. They have to make sure that they are complying with Reg CF statute, which limits what they can do. We've talked about this before, the tombstone type marketing ads, which basically said you're limited to say, this is who we are, this is what we do, this is the terms of our offering, very basic terms, and this is where you can find information, basically setting a link to the portal. You can do, those are called, terms type marketing, or you can do a non-terms offering where you basically are saying you're advertising the deal, but you can't have any of the terms in the deal in your advertising. So you couldn't mention, become an owner. That implies that you're selling equity, or own a piece of the next whatever. First of all, that'd be promissory, and you don't want to make that representation. But second, if you said own a part, that again implies equity, so that wouldn't fly. But be a part or help towards the success of your favor, next company, that would be permitted. So it's definitely difficult waters to sort of navigate through because you're limited on the one hand. You have these sort of two paths, but they're both It both definitely are limiting the way you can do it. That's one of the disadvantages, I think, of Reg CF offerings.
So what are the legal obligations required for an equity crowdfunding site? So if someone says, this is great, I raise capital, I want to have a equity crowdfunding site, what are their legal obligations?
They want to have an equity crowdfunding site. So again, that depends on what type of business they want to have, what type of platform they want to do. If it's just an investor,
Are they broker-dealer, that type, and then there's also the offering type, right? There's the which role you're playing and which offering type you have accessible for. So if you have a Reg D only portal, the legal requirements are different than if you have a Reg CF portal, which are different than if you have a Reg Plus portal.
Exactly.
And if you choose to do all three of those, well, that's very possible. You just have to be very cognizant of all three legal responsibilities.
Yeah, and again, the only Reg CF funding portal needs to be approved by the SEC and FINRA. So, whereas the other two do not, there's not a review process that you need to go through. And so that being said, if you're doing Reg Plus or Reg D offerings, you need to make sure that you're either working with a broker-dealer or your compensation model is such that you're not acting like a licensed broker-dealer.
And if you have a Reg CF portal, you can get success fees and equity in the raises that you're representing on your portal, correct?
If you have a broker-dealer?
You're not a broker-dealer, but you have approved Reg CF portal.
Yes.
You're allowed to have equity and success fees and commissions on the raise.
Yes.
Are there any limitations to the success fees and or equity you're able to take?
No. No, but then that just becomes like a business term, right? I mean, if you're charging somebody 15% and the portal, the next portal is charging 5% or whatever. I mean, I think that's just market driven. I think right now you're seeing
whatever the market will bear,
2.5% to 5%.
Yeah. So there's need for clarification on Reg D, where a private company, they're asking about what are the limitations for Reg D with private companies? Can private companies leverage Reg D and crowdfund with it? And I think the short answer is yes, under 506C, correct?
Yeah.
And so any private company could take advantage of the crowdfunding laws without even going through FINRA approvals on the Regulation CF or Regulation Plus by leveraging Regulation D, either 506C as in Charlie or 506B as in boy. As we talked about in previous webinars, if it's a 506B as in boy, then there has to be a pre-existing relationship for them to participate in the raise. But you do get with that, you get 35 exemptions for friends and family to also do it. If you forego the friends and family 35 retail investor exemption, you can do the 506C as in Charlie, do direct solicitation, and that private company could raise an unlimited amount of money through accredited investors. Because FINRA and SEC have determined that accredited investors can basically take care of themselves, but left it wide open from a marketing perspective, you have the most freedom to market in a 506C scenario. Would you agree with that?
Yeah, absolutely. But that being said, a company could still take advantage of a Reg CF offering just by having that through, a funding portal. They couldn't do it for themselves through their own funding portals, and that's not started. But I've had clients that call and say, hey, I want to do this offering, I want to do this, and I basically said, that's great. You need to file a Form C, and you need to do it through a funding portal, and here's 3 or 4 that I suggest. So if you're less than $1 million, that is a possibility.
So what are all the necessary steps on a Reg D? For people that raise money all the time, they're very well known. Let's go for the people who don't necessarily raise a lot of money. What do you have to do on a Reg D from a approval from the regulatory perspective? Like, you don't have to file to do a Reg D until after the close, correct? There's no paperwork required. So what is, quote unquote, required to do a compliant Reg D?
So and people who have done, people who have raised capital before, they're familiar with this, but it's essentially the same things that you're used to doing. Typically, you'll have an offering memorandum or private placement memorandum, PPM, that is your master insurance policy. It describes the deal. It says this is who we are, what we do, these are our principles, this is how your money is going to be used, here's financial information about us to the extent we have it, and then here are all the risk factors associated with this type of investment and this type of business and this industry and so forth. So that's what's needed. So investors are typically given a PPM, they're given a subscription agreement, a copy of the company's organizational documents, whether that's an operating agreement for an LLC or the bylaws or articles if it's a corporation, and that's kind of the package that an investor would get. And then once the investment is made, then the issuer is required to file a Form D within file with the SEC, and then within 15 days of that first sale, you've got it in every state. In each state, you've got to file.
Each state an investor participated from.
Exactly. So, for example, if you file, if you sold in California, you'd have to file a Form D in California within 15 days.
And what's that Form D? It just says this citizen participated in our raise.
And you don't even have to say who it is. It's just a notice filing. It's not proof. There's not really a review process. I know that state regulators will look at those and see if it raises other issues, but it just says this is who we are. This is how much we're seeking to raise. This is how much we've raised to date. This is how much we've sold. They're kind of what it is it's looking for. There's questions they ask that can spawn additional questions, troubled areas. So they want to see, did you pay anybody in connection with this offering? So you have to disclose who got paid, any commissions. They want to see that because if you're using a unlicensed broker-dealer, they want to know that. Or if you are using a broker-dealer, they want to make sure that person is, licensed on their radar. The other thing is they'll, if you file and you say we are the blank real estate fund, the state might say, it looks like you're operating an investment fund. Are you, are you a registered investment advisor? And so that might raise these other issues. I know that, with clients we file Form Ds and you hear back from the state regulators with those types of questions. Red flags go off. So
let's talk about the PPM. I hear from a lot of portal owners, or soon-to-be portal owners, hey, Brent, CrowdEngine's the best, the pricing's the best, but those darn legal fees are killing me. Or I really have to have a unique PPM every single offering when it's the same information. So let's just talk from a real practical sense, kind of a best practices view perspective, per se, of when is it appropriate to have a PPM drafted by a lawyer. When, if any time, is it appropriate to have it done through a template? Where are the good fits? Where are the bad fits? What are the risks? And kind of just let's share some light on that general topic.
Yeah, so I know that there's, lawyers are going to have one answer. There's going to be, I know there are companies out there that will, auto-populate a PPM, and I think some of those are great, and I've worked with them. There's other, management companies that are, or I've come across like fund administrators that will actually for prices that are more expensive than sometimes lawyers provide you with a set of, approved documents or template documents. I don't know if there's any sort of magic to it other than I suggest that, again, I'm a lawyer, so this is the position I'm going to take, but it's always good to have those prepared by a lawyer that understands the industry that I understand that's kind of up to date on trends and can tailor those. One thing that I see that's really interesting is I'll see these sort of stock Form Cs or PPMs that come through that, they've pulled off the internet or they've used some service provider or whatever, and it's just this, and it doesn't even apply to their industry. I mean, it might talk about, selling alcoholic beverages and the risks associated with that, and it's a software company. So you go through and you'll see these templates that they don't apply, and they're not reviewed, so it doesn't really, the SEC regulator's not going to ding you for it. But where it potentially hurts you is, and we've talked about this before. As long as everything goes well, your PPM, it doesn't matter what it says. Where it's the insurance policy for when things don't go well, because the first thing an investor, if they lose their money or if something goes bad, they're going to do is their attorney is going to say, I want to see, their plaintiff's attorney is going to say, I want to see a copy of the fund documents, or your PPM, and they'll look, and if something that happened isn't disclosed in a risk factor, or if you've got these poorly written risk factors, or if it's just a template, it's just not going to hold up. I mean, that plaintiff's attorney is going to tear it apart. And so what I typically... Which
opens the door for a bigger lawsuit or a bigger issue.
Yeah. And now, they're going out and getting all of the investors to come in on it, together, and make a class action claim. So it makes sense to have it done. And again, you don't want to go and I don't think you need to go and spend, a ton of money with, a Wall Street law firm, because they're going to charge you, out the ear. But I think what makes sense is having somebody of experienced securities lawyer prepare that. One thing that I've been doing for my clients that are operating platforms, and sort of part of the package of what I offer is, I'll say, here, I'm going to prepare what I've heard is a industry-specific set of documents that we can tailor every time, so that we can, with the ability to tailor that for each deal. So I'm not charging just a flat fee. Here's for this flat fee, you can get all of these sort of documents, and then every time an issuer comes on and wants to raise capital on your platform, we'll make the tweaks necessary, or I can walk you through that you guys can make the tweaks necessary so that it you apply, but you're not regenerating a brand new PPM every time.
Yeah, because some of our clients, they might be selling either apartments in Mexico or fix and flips, where it's really the same deal every single time. It just it resurfaces itself with a different address, but it's extremely similar in their particular business model, right? They don't have a wide range of types of offers. It's like I source these deals, they're cookie cutter, and that's the magic. Everything's cookie cutter. Yeah. And when they look at, wow, I'm going to pay that much for a PPM each time, they're scratching their head, what are they paying for, right? Yeah. Because the information is more static than it is changing. And so is that a case where it's appropriate to do kind of more of a template, and then after the first one's built, appropriately?
And one of the people you mentioned, I think I've talked to, and that's the idea. We'll set up we want to make sure that the first one is right, and that's where I think you get sometimes I get pushback, and they're like, well, here, I'll do it, and I've got a template, or I found something, and I'm happy with that. That's fine. I'll review it, but you want to make sure the first one's right if you're going to, especially if you're going to replicate it over and over again. That being said, the economics of the deal might change. So even if you're doing, all of our deals are single-family residential properties. So our PPM is going to look the same because it's all single-family residentials. So it shouldn't change. Well, that's great, except for you're not selling the exact same house on the exact same plot. There's different markets, and you've got to address the issues specific to that market. Or if it's a lower income, a house in a lower income neighborhood, there's risk specific with that. Versus if this is a luxury home in Aspen, there's going to be risks associated with that are different. And that doesn't take like a complete rewrite of the bill, but it does take how do we address that? How do we talk about
you can't assume everything is the same just because 90% is the same, 95%.
Yeah, and that's sort of that's kind of the value proposition that I propose to my clients is, here, let me help you prepare the document up front, and then we'll make those tweaks as necessary to get an ideal for, without having to recreate the whole process.
So more on the speculation side, do you see regulations opening up at all to allow different roles where people play in the deal, like unregistered broker-dealers or finders of the deal, to be compensated? Legally compensated, I should say.
That's one thing I haven't seen.
I haven't either.
And I don't know if you will. That has always been a hot point with the SEC and with FINRA. I mean, you've got a whole regulatory agency designed around that.
Yeah, that's bucking the establishment.
Yeah, and the whole Reg CF, funding portals is an interesting thing because that allows these companies that have not, it allows people, entities that have not gone through the whole license. They've gone through the FINRA licensing process, but you don't have to sit for any exams. You don't have to have a Series 63 or a 7 or 20. You don't have to have any licenses per se. You just have to go through and be approved by FINRA. And that's why it takes so long, and that's why there's been a process. But they can act like broker dealers. They can charge commissions. They can sell securities and be paid for it, and receive a commission on it without having to go through all of that steps. And that was a big deal. Broker dealers, I think, have been, it's raised eyebrows with that, and they've thought, well, that's part of our industry.
Why did I go to college?
Yeah, exactly. So I think that was the step, but I don't think I would be hard pressed to see that.
Yeah, it could happen under this administration. Crazy, who knows? But I certainly wouldn't hold my breath. I don't see any political motivation to fix that part of the crowdfunding laws. I mean, I think limits are often talked about. Let's raise this limit. Let's take that. But when it talks about actually compensating different people for different roles that aren't registered or licensed, I've heard nothing about that. So it tells me there isn't an appetite on either side to put a lot of attention to it. Right? No one says, what's broken is we don't pick compensate finders. While it may or may not be broken, I've never heard that in any trade show I've gone to, panel I've spoken at. It just hasn't gotten anything. Moreover, when we've gone back to D.C. and talked to the politicians again, no one's ever said, the problem with America and getting capital to the new businesses is we're not compensating finders and unregistered broker-dealers. So I just don't think there's going to be any movement in that by my estimation, but I could be wrong.
Yeah, I don't see that as a problem either, but like you said, crazy things are
wild card.
Are afoot, so
Well, this concludes our webinar this month. Thank you everyone for attending. If you have any questions you'd like to follow up with me afterwards, please feel free to contact me at my address, brent@crowdengines.net, or Marty Tate. What's the best way to get a hold of you?
mtate@clilaw.com or 801-534-4425.
Thank you, and have a great week. Take care.
Thanks.